Welcome everyone. So today's training is going to be practical and direct. No flashy slides, just a straight dive into the whiteboard. So I'll be walking you through why, if your goal is, freedom and building a life on your own terms, this is one of, if not the most powerful vehicle available. We're going to be breaking down exactly where to begin, how to decide what type of business to acquire, and also the different ways in which you can structure and fund these deals. I'm also going to cover how to source opportunities, what to look out for, and I'll also share some real case studies so you can see how this plays out in practice. So let's get started and dive straight in. So who am I? Well, some of you already know me, some of you don't. So here's a very short version of how I got here. I don't have an MBA. I didn't come from a private equity or investment banking background. I left school at 16, went straight into work, failed miserably at a few startups, but I guess those failures became my greatest education. By wearing every hat and running businesses the hard way, I earned what I call my Main Street MBA. But what I learned early on is taking action will always beat just collecting information. Anyway, since then, I've been involved in more than 30 acquisitions across multiple countries using, various different creative deal structures. My core play has been consultant for equity. That strategy alone has allowed me to build a quite significant portfolio of options and ownership stakes. That's one of the strategies I'll also be breaking down for you today with real case studies, just so you can, see how it works in practice. But look, it's been an interesting few years. Around the time of COVID, I started to share my journey online, and what began as, me putting my thoughts out to the world actually turned into something much bigger, an incredible network. Some has become, close friends, others business partners, some has, been the source of deal flow for me and my team. Out of all that momentum, the 5D program was born. It wasn't a master plan. It actually started out as a bit of a passion project and has actually become one of, the most rewarding parts of what I do. Anyway, fast forward to today. My team and I are, still in the trenches, still completing full buyouts, taking minority stakes and, structuring deals across UK, UAE, and the USA. And throughout this video, I'm going to be giving you content so, you can take it straight into the market right now. The truth is, anyone can do this. You don't need luck, the perfect CV, a polished background. But what you do need is a very simple process, clear vision, and definitely the right people around you with all the tools that you need to get the best results. That's what brought me to M&A. That's why I'm so passionate about showing you how to, use it as the most powerful vehicle to build freedom, wealth, and, the life that, you're genuinely proud of, because that's what it's done for me. All right, let's tackle something that you've probably heard over and over in the news, on social feeds, pretty much everywhere. If you can get 10% returns, you're crushing it. Well, unfortunately, that's not true. So, if we start with inflation, officially, the UK figure sits around 3%. But, that headline number is pretty misleading because, what really happens behind the curtain, for example, if beef goes up in price, but, chicken stays steady, the Office of National Statistics gives chicken more weight, assuming you'll just switch, then they mask the real rise in your living costs. They actually use something called geometric weighting. So if one item jumps 10%, but the other falls 5%, the average shown is far lower than, what you actually feel in your wallet. I guess this will resonate with a lot of you. And then also, they add products that, naturally fall in price, like TVs or smartphones, which then drag the index down, even if food, rent, and energy costs are going up. Now, the real reason why they do this is because the CPI, so the Consumer Price Index, is actually tied to pensions, wage rises, and government bonds. So keeping the CPI low keeps liabilities low, which gives, the illusion of stability. Now, the truth is, real inflation runs, far higher than the official figure. So when someone says, our property's gone up 8 to 10% a year, I'm beating inflation, they're actually using the wrong benchmark. So once you actually see how inflation is calculated, you stop listening to the headlines and actually start digging into the real data. So, if we did run the numbers, so let's say real inflation averages around 12% a year, which in my opinion, that's, us being generous. Now, according to Yopa, UK average house prices rose 51% over the last decade. Now, that's average house prices, okay? But when we adjust for inflation, those property values have actually lost around half of their purchasing power. So, on paper they went up, but in reality they fell. So, look, if your assets aren't outpacing real inflation, you're not building wealth like many people think they are. You're actually standing still, or even worse, sliding backwards. So, that's why I've doubled down on M&A. Buying the right businesses, structuring deals properly, and driving growth creates both cash flow and equity that blow past what property or index funds can even try and deliver in today's climate. And in the next few minutes I'm going to be breaking down exactly how and why once you see the numbers, you'll never look at 10% returns in the same way again. Now, before I dive into the framework, I want to talk very quickly about the silver tsunami. This is what the media is calling this. Baby boomers are retiring. Tons of businesses are about to change hands. In the UK, 62% of small businesses are owned by entrepreneurs aged 55 and up, and less than 15% of boomer-owned businesses actually plan to stay in the family. Now, let's be honest. Most kids, these days, they don't want to own their parents' skip hire or logistics company. There's a bit of a generational mismatch of supply and demand. The supply is swelling, but the demand hasn't really caught up yet. We're in a very unique moment in time right now. And look, Entrepreneur Magazine actually posted an article stating how many younger entrepreneurs are overlooking this market. They're still obsessed with starting from zero and building the next big thing, chasing shiny objects, or I don't know, dancing on TikTok, right? But buying an established business gives you upside, influence, and also control. You're not out there hoping for returns, you're actually creating them. Okay, so where's a good place to start? Well, we're going to start with search criteria. What is it we're looking to buy? Now, that's going to come down to a few things. The first thing is going to be financial. So, we're going to be looking for something that generates, a good amount of revenue, something that's, profitable, something that actually cash flows, because, profit and cash are two different things. They're not the same thing. And then also, what do you want out of this? So, what do you want out of this as well? And then once you know what you want out of this, let's say you want 500,000 a year, 100,000 a year, 50,000 a year, whatever it is that you want out of this, at least then you have something to work backwards from as well. So first and foremost, the financial criteria is going to be one thing, because there's going to be some companies that can give it to you and there's going to be some that can't. And then next, we're going to look at sector. So what industry are you looking to acquire in? Now, you could be looking at trades or construction in general, healthcare, logistics. What is it that you want to acquire in? And it's going to come down to a few different things. So it really depends. Now, first and foremost, do you have experience in a certain sector? Now, obviously, there's two avenues to this. You either do or you don't. If you don't, then you're definitely going to need something with a strong management team. Now, we are looking for something with a strong management team anyway, but if you don't have experience, then, you definitely need a strong management team, or, you can partner with someone in the sector. You can bring in a non-exec, or, a consultant, or an advisor, but really think about this before you dive into it. You may just see a sector that you see has, a lot of growth or upside, or something that you're interested in that you don't have experience in, but you still want to try and find something in the sector. These are the things that you're going to need to think about, okay? Then, if you do have experience in the sector, this is quite a big tick in the box for banks. Banks like it if you have experience. You can definitely, integrate a lot faster. Definitely helps if you understand the market and, the sector in general. So we have financial qualifications, we have the sector that you're looking to acquire in, and then you need to decide whether, you want to become an operator or an investor. Now, these require two different skill sets. If you're going to become an operator, you're probably going to look at, what strengths you have. Maybe it's AI, sales, maybe you come from, a management background, maybe you've been in finance. Have to really think about, the skills that you have to go in and be an operator. And I think that, there's two different avenues you can take here, right? There's some people that do want to go in, be an operator. They understand what cogs to turn, what levers to pull. They want to go in and grow the business themselves. Then an investor may come in and say, well, I want to focus directly on acquisition and bolting on other companies to this. I want to take more of a strategic role where I'm happy to let the management team do exactly what they want. Now, if that's the case, you definitely need a very strong management team, one that you believe has the ability to take it to the next level, because the management team that's got the company to where it is today may not be the management team that's needed to get the company to where you want to take it. So, really think about that. And that's a consideration I think, you should think about. Then also, you're going to want to look for something that does have strong cash flow. So that's really going to be a very solid tick in the box that you're going to need if you're taking a complete hands-off-ish investor approach to this as well. And then lastly, you're going to want to make sure that the company you're buying actually has upside potential. So there could be some headroom that you see already, or you may be able to identify where the value creation is coming from. It could come from acquisition, but that's something that you definitely want to consider is the upside potential as well. Now, of course, if you're looking at a company to buy and the owner's running day-to-day operations, earnings a week, and value creation is just completely uncertain, then of course that's going to be an absolute no. Okay. Now, if you do find someone that's a motivated seller, maybe they're looking at retirement, maybe they're part of the silver tsunami, who knows? Unfortunately, some of them may have, health conditions. This is another big one. A lot of these boomers are coming to the age where, health does start to deteriorate. So, a lot of them do have health conditions, and that could end up being one of the core drivers to them, wanting to sell. And sometimes they've just had enough. They've been doing this for decades. And these are the owners that you find are very helpful throughout, a transition period. You really understand their motivation for sale, and you're both really trying to create a win-win because they've had enough. They probably know that the business could go on and do great things, but they've just completely, run out of energy for it. And, you inject some new energy into the business, and then you continue on the pathway the business should be going on. So just to summarize your search criteria very, very quickly, this does not need to be complex. You need to try and simplify this as much as possible. First and foremost, you need to understand the financial criteria or financial and time criteria that you're looking for personally. This is personal. This one will be different for everyone. Then you got to look at what sector you're looking to acquire in. Consider whether you have experience or not, or who do you know in the sector. You may know someone that maybe not have direct sector experience, but they may know someone in the sector that through network you can, gain a contract, or you find some synergy with somebody that you could potentially partner with. If not, you like a sector, then and you don't have experience, then look at, a strategic partner, maybe bring on a non-exec or a consultant to the deal. But remember, if you do have experience, one thing I will say, many people may have been in the industry for many, many years. Let's say, for instance, you've been in, commercial cleaning. Maybe you've been in that industry, maybe you've been in a senior role and you've been in it so long that you no longer want to be a part of the industry. So you go and search for something else. What I will say, if you have experience in the sector, forget about what you're passionate about, okay? I know people say follow your passion and you'll never work a day in your life. But forget about the industry you're passionate about. If you've always had a passion for being in, a tech company, just forget about it for the time being, okay? If you're taking a more of an investor approach here and you find something that you already have knowledge in, it makes total sense to do it. This isn't going to be the same as what you've been doing. Okay. You're going to be the owner of the company. And one thing I will tell you, the reason why I said forget about passion is because something that you're passionate about, if it's failing, if it's hard and it's stressing you out, you no longer become passionate about that company or that thing anymore. If there's something that you have zero passion for, maybe you're selling pet food and you have no passion whatsoever, but all of a sudden it's making you a lot of money that is, ends up giving you the freedom and you get to build the life on the terms that you want. Guess what? You become pretty passionate about that thing. So just bear that in mind when you're deciding on your search criteria. So once you've mapped out your search criteria, the next part of the process is going to be discovery and data collection. So as you start speaking to business owners, you're going to want to start to build out a business overview of those businesses that you're speaking to. Now, first and foremost, you're going to want to make sure that you're building rapport with those business owners. You're going to want to make sure you find out what the motivation of sale is of those business owners. You're going to want to probably ask some more in-depth questions about the business itself. So you want to try and find out a bit about, the history of the business. And then you're going to want to try and find out as much as you can about the staff and the org structure in general, who does what, where the reliance is in the company, which then, leads us on to, do they have a management team? If then you want to figure out if there's, any key man risk in the business. If they do have key man risk, is it the owner? If it is, then you're probably going to want to ask some, even more in-depth questions around what it is they do on the day-to-day, what parts of the business is reliant on the owner, or is all of it relying on the owner and they're just a complete operator? Because if they are, then, the replacement cost of replacing, an actual owner entrepreneur is going to be far higher than going out into the market and just finding someone to replace a member of management. And then you're going to want to look at, what property they have in the business. If it's, if it's owned, if it's leased, if it is owned, is it owned in the trading company? Is it owned in their SaaS? Is it owned in their personal name? Is it owned in a property company? But we're going to need to know this information because it will change the structure of the deal. Now, the good thing is we have a script inside the 5D program that pretty much works out all this for you in 15 minutes. So you're not going to have to take hours collecting all this information. You can literally get this done in 15 minutes. And in most cases, you've already pre-qualified the business owner before they've even come on the phone with you, which is great. Anyway, so part two of this, so this is part one, this is part two. This is going to be follow-up via email after you've spoken to the business owner. So first of all, you're going to want to summarize the call in the email. You're going to want to talk a bit about all the things you've discussed. It's good for them to know that you've listened and you've understood, what they've said. And then this is where you're going to go through the data collection process. So you're going to want 3 to 5 years management accounts. Sorry about my writing, guys. You're going to want to see an up-to-date sales ledger. You're going to want to see an up-to-date P&L and balance sheet. You're going to want to get an employee matrix. Of course, they can redact the information of the names, but you just want to see, what role somebody's playing and also what they're getting paid to play that role. You're going to want to see any, work in progress or pipeline that they have, an asset register, and any lease terms, if any. Of course, this really depends on the property assets in the business. Now, that does look like a lot of information to ask on a follow-up email. This really depends on the rapport that you've built with the seller up until this point. Remember, simplifying this is the most important thing of all. So if you feel the business owner wouldn't appreciate an email asking for all this information, then maybe follow up on email, summarizing the call. And when you go through the data collection process, just ask for 3 to 5 years management accounts, an up-to-date sales ledger, an up-to-date P&L and balance sheet. And then as you build additional rapport with the seller, then you can ask for all these other things. And of course, sector dependent and business dependent, there will be other things that you're probably going to want to ask as well. So the next part of this is valuation. Now, up until this point, you probably would have spoken to the seller a couple of times by now. You would have collected a ton of data. And, with that data, we need to decide what we think the business is worth. So this part is valuation. Now, this is the fun part, in my opinion. So we're going to use some numbers as an example. So we're going to say that the base EBITDA is £500,000. And then we're going to look at what adjustments need to be made to that EBITDA. So for an example, there could be some directors' pension contributions in there of 60,000. So we're going to add those back to the EBITDA, which takes the EBITDA to 560,000. But then we're also going to look at some other adjustments too. So maybe there was some, dependency in the business, which means we need to add some replacement costs in there. And let's say, for argument's sake, that was £70,000, which means our adjusted EBITDA is £490,000. So remember, we started at 500 as the base EBITDA. We looked at the adjustments. In this case, we have a director's pension that can be added back because that's not a cost that's going to continue after they've sold the business, which took us to 560. And then we've realized there's some dependency in the business and there's some replacement costs needed. And we're going to put this at 70,000 as an example, which then brings our adjusted EBITDA to £490,000. Now, once we have our adjusted EBITDA figure, we're then going to apply a multiple to that figure. Okay, now for argument's sake, let's say today we're going to value this company at 3 times adjusted EBITDA, which takes our enterprise value to 1.47 million. Now, there's some other adjustments to be made once we have our enterprise value. So if there's surplus cash in the business, which is any cash on top of working capital that's required to continue to operate the company, then that can be added to the closing payment and the business owner can take that out as well. So let's say in this case, the business owner has 200,000 of surplus cash in the business. And then also, let's say there's a property in the deal as well. And let's say that's worth 300,000, which is, completely separate from the business itself. So then that takes our total valuation to 1.97 million. So now we've decided that the business, with all the adjustments that we've spoken about, is worth 1.97 million. That's when we go into structure and how we would put this deal together, which I'm going to show you in a few case studies in a sec on how we're putting these deals together once we figured out what we believe that they're worth. Now, before we dive into the case studies and deal structure, I just want to talk very quickly around, the word wealth. Now, I do feel like it's a bit of a buzzword online. There's various different ways to create what people call wealth. And also people have different outlooks on what, wealth is. But what I will say is the baby boomer generation holds all the wealth. Now, that generation in general did very well. They did actually build a lot of wealth. But what I will say is the average pension pot for a 65-year-old in the UK is £75,000. Now, if we look at the average cost of living, and we'll just take a 2-bedroom flat outside of London. We can't really bring London into the equation here, but an average 2-bedroom flat outside of London works out around £1,800 per month. but that does include rent, utilities, food, and transport in regards to the average cost of living in a two-bedroom flat outside of London, including rent, utilities, food, and transport. So annually, that's £21,000. Now, if £75,000 is the average pension pot in the UK and the average cost of living is £21,000, then you're not going to be living a very good retirement if you followed traditional methods. Okay, your money will last around 3.5 years. So this is why, as early as possible, you think of different methods in which you don't need to rely on a pension, full stop. So the good thing inside the 5D program is if you're unsure on valuation, unsure what questions to ask a business owner, what to do with some of the data that you've collected, then we run a deal or no deal session every single week. You literally have to scroll down on the left. You click deal or no deal submission form. You submit your deal into deal or no deal. And then once a week, myself and my deal team come on the call. We review the deal. If there's any questions that need to be asked, then we tell you what to ask. If we're at a stage where we can actually piece together an offer, then we'll piece together the offer. Or if it's just a complete no deal, then we tell you there and then on the call, so you don't have to waste any more time. But we literally go through the numbers line by line with you. We pop them into our deal sheet. We tell you what you should offer, the best way to fund the deal, and then, of course, what to do next. So let's move to the next stage. Let's just assume that you sent over an offer. The seller's happy with the price and terms. So now we need to send over a heads of terms or a LOI. Now, this is a very basic heads of terms. This is the sort of thing you could literally sketch out on the back of a napkin. But the goal here is to get the fundamentals down first, the base price, the structure, and the key terms. Now, in our 5D template, you will get a lot more detail, all the legal jargon around costs, exclusivity, confidentiality, and everything else. But before you get to it, you need to make sure that the commercial side of the deal actually makes sense. So you put the buyer, the seller, the date, the business or the company number, the price you're paying for that company, the terms of payment, the type of sale, whether it's an asset purchase or a share purchase, the target completion date, and then any special conditions that's required. So that's a bit of an overview of what you need to do when you get to heads of terms or LOI stage. Okay, so we're going to dive into some case studies in a sec, but I guess the big question is, how do we actually find these off-market deals? Because let's be honest, you don't want to be spending your time scrolling through public listings or talking to brokers if you can help it. That's definitely not where the best opportunities are hiding. What you really need is volume, and not just any volume. You need off-market volume, because most of the business owners that we buy from, they don't even know they want to sell yet. But that's when, the magic happens, right? Now, what's exciting about this is one of our members recently partnered with a US-based AI firm to develop something pretty special, which is Logan Room. Now, Logan Room is a custom software. It helps you find off-market deals literally on tap. You can scale your outreach as much as you want. Right now, it is only available to 5D members, but the results have been absolutely incredible. Now, before Logan Room was official, the same method was being used, just slightly differently. Now, to give you a bit of insight on this, around 18 months ago, we was using this outreach method. There was 5 of my team back to back taking calls with business owners on a day-to-day basis. We actually employed a 6th person to take calls for us, just to take the discovery calls, collect the information, and then we can decide whether the business was something that we was looking for. We ended up being so upfront on our outreach on the initial touch point because the volume was absolutely crazy. So we had to turn this down, and this is something that other people in the group have had to do as well, is actually turn down because the volume is absolutely crazy. Now, Logan Room is very easy to use. In 3 clicks, you can get as many leads as you want. All you have to do is type in your full name, your email, the sector or SIC code, and the location. You click next, you pick how many leads you want, and then those leads get delivered to your inbox. And then we have a step-by-step system to make sure that we're using those leads in the best way possible. we use a guide to make sure we only speak to businesses that actually fit our criteria, which keeps the process super efficient and also fully automated from end to end. So now I'm going to be taking you through 4 case studies. All are slightly different, but I'm going to show you how deal structure can be the absolute difference when doing deals. Now, the first deal we're going to look at is a deal in the personal care sector. Now, this business has a turnover of 1.2 million and an EBITDA of 250,000. And they had, if we look at the cash in bank, they had 370,000 pounds in the bank. Now, let's look at the actual deal structure of this one. So, the purchase price for this was agreed at 1.4 million. Now, this was made up of 384,000 pounds of goodwill, 267,000 pounds of surplus cash, and then 750,000 pounds of a property, which actually was, it was 2 flats and a shop over 2 floors. Now, to give a bit of context on the surplus cash, let's break down this cash in bank figure. So there was 267,000 pounds of surplus cash. There was a 53,000 pounds corporation tax liability, and then there was 50,000 pounds of working capital that was left in the company to continue to operate the company as it was. So let's look at how we put the deal together. So the closing payment, or the day one payment, was 267,000 pounds, which actually came from the cash in bank. Then there was 384,000 pounds that was spread over 36 months in deferred payments. And then we have the property at 750,000 pounds. Now, even though we had 3 different estate agents come out to the building and they valued it between 850 and 875, we actually agreed at 750. Now, the closing costs for this deal came to 23,000 pounds. That 23,000 pounds was actually charged to the deal, which had our money standing at 0. Now, there was a few things that sweetened the deal, because we just talked about adjustments when we looked at valuation. There was actually some extra add backs. So their son was taking 6,000 pounds out the business, and they was taking a pension of 40,000 pounds out the business as well. So if we add the 46,000 to the 250,000, we actually have an adjusted EBITDA of 296,000 pounds. Now, this is how you really work on deal structure and build out the best structure possible to put one of these deals together to ensure you're not under massive pressure just after you've bought the business. This has left enough free cash flow in the business to operate the company smoothly, but also be able to pay yourself as an owner of the business. Now, before we get into case study 2, make sure you download the boardroom booklet. Now, inside here, we have all the key metrics that we initially look for deal analysis. So, year-on-year revenue trends, revenue growth rate, cost allocation, profitability metrics, the actual financial position of the company, cash flow efficiency, revenue breakdown, customer-based, customer acquisition strategy, customer value metrics, acquisition costs, operational risks, resource allocation, business constraints, management capability, and scalability. Then we also have some terminology sheets in here as well, just to get you up to speed on the whole process. So make sure you download that as well as you're going through this training. Case study 2 is a great example of how you can get creative when doing deals. Now, this deal was done by 2 5D members, Alex and Sophie. Both came from a teaching background, Very new to business, had zero business acumen, did a bit of property beforehand, and they was looking at various different companies in different sectors. They actually had about 5 businesses, maybe even 6, at heads of terms level, and they had to make a decision on which route they wanted to go down because they had a few nurseries, they had some construction companies, and some others as well. They decided to pursue the nursery, with having a background in education, even though they actually only spoke to about 4 or 5 using the Logan Room 5D lead generation strategy. They literally spoke to about 4 or 5 nurseries before finding this one. So this business had a turnover of 468,000, an EBITDA of 132,000, and it also had a property in the trading company that was valued around 390,000. Now, the purchase price that they agreed was 487,000 pounds. The closing payment, so remember the day one payment was agreed at 390, which just happens to be the value of the actual property. And then the deferred payments, so the seller finance, the money that's going to get paid out of the cash flows of the business, was 97,500 pounds, which was agreed to be paid over 36 months. They also had 55,000 pounds in working capital left in the business on handover, and there was a bit of a bonus to this one. There was a bottom floor flat, which the seller agreed to renovate. So a nice sweetener on the deal there. So how was this one funded? Now, this is where you can get very creative when doing these sorts of deals. Now, as the closing payment, the day one payment was for the actual property, then there was a deposit needed to fund the mortgage, which Alex and Sophie got from a business loan against the business. So they took out a cash flow loan against the business to fund the deposit on the mortgage for the property, which allowed them to close the day one payment. And then they spread the other 97,500 over 36 months. Now, this was also a no money down deal. Now, the crazy thing about this, you would think that banks don't like it when you double up on debt and you use some debt to fund the deposit of more debt. But in this case, there was no issue. And this deal was also done with no money down. So I don't know if you noticed, but these businesses are being bought for very low multiples. Now, if you follow our framework step by step, these are the sorts of deals that you will be piecing together. This is how you will be structuring deals. And if you use our lead generation system, these are the sorts of deals that you're going to be finding off market. Now, this next business is in the construction sector. Revenue was 2 million. EBIT on this one was 400,000 pounds. Now, this one did have some assets. It had some vans, tools, a bit of plant and machinery as well. And there was a bit of stock there in regards to, say, materials. Now, this one, purchase price agreed on this one was 600,000, which again, very low multiple at 1.5 times. The closing payment, or again, the day one payment, was 250,000 pounds. And then the deferred payments, or the seller finance, that's going to get paid out of the cash flows of the business, was 350,000 over 48 months. So as you can see, this has been spread over a slightly longer time than the last two. Now, how was this one funded? Well, the closing payment on this one was funded using a cash flow loan, and the free cash flow after tax was 320,000 pounds, which, per month is just over 26,500 pounds. Now, let's take a look at this and break this down a little bit deeper into the numbers. Now, the actual debt finance in this worked out around 5,500. And then we also have the seller finance, remember, that's going to be sitting in there at 7.2 thousand pounds, which in total comes to 12.7 thousand pounds per month in monthly debt service. So let's take a look at the post debt cash flow. Now, if we look at this and we know what our free cash flow is at 26,000 and we've got debt service of just over 12,500, our post debt cash flow is £13,900 a month, which equals £165,000 per year, which pretty much puts you in the top 1% of earners in the UK. Again, revenue or turnover, 2 million, EBITDA, 400,000. Agreed purchase price for this business is 600,000, which is a 1.5 times multiple. The day one closing payment, 250,000, funded by a cash flow loan. The deferred payments or seller finance was £350,000, which was agreed to be paid over 48 months in actual. This was actually paid in quarterly installments. The free cash flow after tax is 320,000 per month. That works out at 26 and a half, that 26.6 thousand. And then our debt in the business. So our monthly debt service is made up of the cash flow loan, which is 5.5k a month, and the seller financing, which is the deferred payments of 7.2 a month. Those together gives us a total monthly debt service of 12.7k per month. And then our post debt cash flow is 13.9k, which gives us a total cash flow of £165,000 per year. Again, this can only happen with good, solid deal structure and a good understanding of how this works. Again, our exact framework teaches you how to do this, how to put these deals together, how to negotiate and gain negotiation leverage throughout the discovery process to be able to talk to sellers in a way that they understand that these deals work for both sides. Okay, so I'm about to show you the last and final case study of this training. This case study is a consultant for equity deal. Now, before we dive into this, there is just one thing I want to cover beforehand. As you can see, I'm trying to get through this as quick as possible, give you as much value as possible, and show you various different deal structures. Now, just before this, we've talked about adjustments, so add backs or even negative adjustments. Now, just so you know going forward, if it's an add back, this is what the seller has spent that you won't after you bought the business. And if it's a negative adjustment, it's what the seller hasn't spent that you will end up spending. So when we've talked about replacement costs or pension contributions or various other adjustments, this is what you need to consider when you come to valuation. Now, this last case study, consulting for equity, is my favorite strategy personally. All of them serve their purpose. All of them are super high leverage. So you decide which one suits you. I just want to show you the power of each one. So we've talked in quite a lot of depth about leverage buyouts inside the 5D program. We also talk about distressed deals, roll-ups, and various other methods as well. This one being consult for equity. This was another construction company. This one had a turnover of 9.4 million. And EBITDA of 658,000. Now, they did have a current valuation done by their accountant at 2.6 million, which is around 4 times, which I actually think is quite a fair valuation for this business. They actually had assets as well in the company of over £1 million. That's made up of plant and machinery. So initially, I approached the owner to actually buy the company, realized that he probably wasn't ready to sell, especially sell the business the way it was. I definitely felt like it had upside, especially having gone through the discovery process and realizing the actual value of the business if they changed a few things. So I spoke to the business owner about the idea of consulting for equity, and my offer to the business owner was a £4,500 per month retainer, which is actually the smallest retainer I've actually ever taken when it comes to one of these deals. You'll see for why in a sec. And then 10% equity linked to KPIs, which we'll talk about in a sec. So this actually is the lowest amount of equity that I've linked to KPIs and the smallest retainer. Now, because this was the smallest retainer and smallest amount of equity that I've ever agreed, I had to try and amplify the deal in a different way and get creative to make sure it was worth my while. So I actually asked the business owner, what's the number that completely emotionally detaches you from this company once and for all? Now remember, the accountants valued the company at 2.6 million. So that figure that emotionally detaches the owner from this business was £5 million. So I said, okay, well, I want 20p of every pound over 5 million. Now, of course, people are happy to give away what they don't have yet. So this was an absolute no-brainer. The fact that 5 million is the walk-away number and the number that emotionally detaches the business owner from the business, 20 pence of every pound isn't a lot to give up because he's already had the number that he's looking to get. I probably should have asked for more looking back. Anyway, the KPIs. So what do we have to actually do to work in to this 10% equity? Now, first and foremost was to grow the EBITDA to 900,000, which of course looks like quite a big jump, right? This was a 24-month agreement. However, when we add a bit of a deep dive into the financials, we realized that EBITDA was already pushing around 750 anyway. So yes, there was still a jump based on the margins that this company was operating on, but there were some other things that we believe that we could do to get the EBITDA up to 900,000. And then there was also a KPI to get the recurring revenue actually contracted to 100K per month. They was actually doing around 75,000 per month already in recurring revenue. However, it wasn't contracted. So it's very much, handshake deals. They've been working with the local authority and other companies for a very long period of time. This is a 35-year-old company. So there actually wasn't any contracts in place. So I said that I could get that revenue contracted and also increase it to 100K a month. So, right, let's look at where we're at the moment. So if we look at the actual upside, now, the initial retainer was actually for 6 months with an option to extend. Now, the option to extend was actually on my side. I believe that I could get the business where it needed to then be in a position where I decided whether I wanted that communication channel still open after 6 months, whether I want to extend that retainer beyond 6 months. Now, the upside is based on the 6-month retainer, 27K in cash collected from that retainer. And then with the EBITDA now up at 900,000, I think it's fair to say a 5 times multiple isn't a big ask, which would then take the new valuation to 4.5 million pounds. Now, of this, remember, we've got 10% equity linked to this, which equals 450,000 pounds. So in a very short space of time, even if it was the entire 24 months, you've managed to create around £500,000 from doing this deal the way it is. Now, there's not many industries out there where you can manage to do this in this space of time. Work with a company that's been going for over 3 decades and be able to extract almost £500,000 out of an initial valuation of 2.6 million. Now, what was the actual outcome of this? Now, to be totally transparent, I worked with the company's accountant. We upgraded their package to a more proactive accountant services. So we had, actual visibility of what was going on. which allowed us to optimize the cash conversion cycle, work on a bit of pricing strategy. So we actually increased prices to 6%, 7%, and then 9% over a 6 month period. Then I actually brought a consultant to the deal that negotiated those contracts with the local authority and some of the other companies that actually got the recurring revenue up to £150,000 per month. And then after working with the accountant, we actually managed to get the EBITDA to 1.2 million in just 13 months. Now, this wasn't a bad company, wasn't a badly run company either. This company be going for, over 3 decades, growing very well, maintained a good size, quite consistent year-on-year revenue. But it just shows you an outsider looking at the business. It's always easier from the sidelines to tell people what they're doing wrong and what they should be doing. But it shows you what you can do by one, getting visibility of financials, two, looking at pricing, and three, optimizing the cash conversion cycle. Now, there's various different ways to create value inside a company. There are a few things that we did with this one. And also, I didn't actually do too much. I worked with the current accountant and who actually valued the business originally at 2.6. It was a different accountant, but it was still the same accountancy practice. And then I brought a consultant to the deal, which I actually give some of my retainer for 2 months to negotiate this 150K a month in contracted recurring revenue. So the actual outcome of this, we sold to private equity for 7.7 times EBITDA, which is actually 9.2 million. Now, 10% of that, which was the agreement, is actually 920,000. Then remember, the part that really sweetens the deal. Now, in under 24 months, which was actually the agreement and the time frame of the agreement, 920 grand in 24 months is still amazing, right? But if you remember, we also agreed 20 pence of every pound over 5 million. Now, this 20 pence ends up being quite a large sum. In this case, is £850,000, which brings our grand total exit to £1.7 million. Now, this required zero capital investment. None of my own money went into this. I actually leaned on network. So again, I work with their accountant. Usually we bring our own accountant to this, one of our own deal team. But I work with their accountant. I brought a consultant that I didn't actually know before doing this deal to the table. And then in 13 months, managed to create quite a substantial amount of value, which allowed us to exit to private equity, which my proceeds came to 1.7 million. So when you talk about leverage, leverage comes in different ways. It comes through, money, it comes through network, it comes through time, it comes through various different ways. This is just one of those ways where we blended a few together to create a very good outcome. Okay, so this is where M&A gets very interesting. So let's say we're looking for construction companies. We'll keep it nice and broad. Now, let's say we go out and we buy 3 construction companies that's doing £500,000 in EBITDA. And let's say we pay a 2 times multiple for each one of those. So we're paying 1 million as a purchase price for each one of those companies. And let's say we don't do the no money down. Let's say we have to put 10% in as skin in the game. Okay. So 10% of our money needs to go in the deal as skin in the game to get these deals done. So we're in these deals for £100,000 each. So now this is where it gets very interesting. So we're in for 300,000. The EBITDA is now 1.5 million. Okay, so once you bought 3 of these companies and they're now doing 1.5 million in EBITDA, they're no longer going to be trading at a 2 times multiple, okay? Just to be conservative, let's say they're now trading at a 5 times multiple. Now, at 5 times, this group is now trading at 7.5 million. Okay. Now, if you think of what we've just done, right, of a £300,000 investment, we've now generated an equity value gain of 4.5 million. Okay. And the actual return on our equity is 1,500%. This is where it gets very, very interesting because as soon as you start acquiring more than one and you start building a group, all of a sudden everything gets multiplied. Now, what's even better about this is every single company you buy from here on out, now you're trading at a 5 times multiple. If you buy them for 2 times, 3 times, or even 4 times, they're coming into a group that's trading at 5 times. So you can start to pay a little bit more for companies at this stage because you're already getting that multiple arbitrage as they're coming into the group. So I just want to walk you through this example very, very quickly. Private equity do this very, very well, but this is where you can really amplify the outcome when you start diving into this. When you download the boardroom booklet, there is a phrase that's become very well known within the community, and it's on the back of the booklet, and it says, "You can't wait for the conditions to be perfect. If I told you that a life-changing deal was 100 calls away, how quick would you pick up the phone, keep showing up?" So make sure you download this booklet. Now, guys, this is not a course. The 5D program isn't a course. It is a consultancy program where we help you acquire your first business, or if you have a business already, we help you scale through acquisition to prepare your group for exit. We take you through the entire process. You work with myself, you work with my deal team. Now, if you are interested in working with myself and my team, then please click the link below, book a time slot in. It will be with myself or my business partner, Zach. We'll have an initial conversation to see if this is a good fit, and then hopefully get to work and do some deals. Hope you enjoyed the training, guys, and hopefully I'll speak to you soon.